Well, welcome back. As you saw before we went to the break, we were looking at the South African Reserve Bank Governor Lesotho Kganyago and other MPC members, of course, detailing the decision this time around to keep interest rates on hold. This, of course, is the first time in 3 meetings that rates have been on hold. We have enjoyed some interest rate relief for the past 3 meetings, a cumulative 75 basis point interest rate cut that has been filtered through from the Reserve Bank. But this time around, the Reserve Bank are just talking about the concerns that they have in terms of where the world does find itself right now. If I can just give you a brief recap, the SARB Governor Lesotho Kganyago talking about the global economic uncertainty in which the world finds itself in. Extremely high, it's sounding like a lot higher than has been in the recent while, just making reference to some of the softness that we have seen in China's economy, of course, with that economy having brought through some stimulus in the recent while, talking about the trade tariffs and the trade tensions, and also some of the weakness in Germany that perhaps has potentially been filtered by renewed or the latest announcements of spending from the newer government in the recent while. As for the South African economy, the South African Reserve Bank talking about the fact that the economy continues to remain weak and weaker than its own expectations. In fact, the SARB having downgraded its growth forecasts for the economy to 1.7%. In terms of inflation, the governor saying that inflation has remained within its target band, just of course noting the numbers that came out for CPI for the month of February, coming in slightly lower than expectations at 3.2%, but mentioning a few concerns around service inflation, although still service inflation coming in within the target band. As I said, the interest rates remaining on hold as the SARB considered it the best decision at this present moment in time, just given a whole host of the external risks, although it wasn't a unanimous decision. 2 MPC members, in fact, voted for a different outcome. But let's get to the take of our experts right now in terms of how they are assessing the latest interest rate decision from South Africa and ultimately the impact on the economy. I'm joined by Carmen, Head of Multi-Asset Strategy at Terebinth Capital, Annabel Bishop, Chief Economist at Investec, as well as Johann, Chief Economist at Old Mutual. And Annabel, I'd like to begin with you, just given the fact that you were in conversation with my colleague Nastasia Arendse a little earlier on Power Lunch, and this was your expectation. What did you make of what he had to say?
Yes, hi, Fifi. Thank you. I thought it was an interesting MPC statement, but not one that is unexpected. Of course, the FOMC also having paused. But what is interesting for me is that the Reserve Bank governors, or the Reserve Bank's inflation forecasts are pretty much in line with ours now. So I think, both of the monetary policy meetings did indicate that that the reserve banks are in the US and South Africa are content with where the economy is now in terms of achieving its inflation objectives. And that's, of course, based on the inflation forecast. The US saw a bit of a dip in the inflation forecast. I think, though, what's key as well is that we saw a change in the voting pattern to not voting for a cut in January, for voting for a cut, a switch now in that ratio. And I think, it also given some of the commentary as well, where they are saying there's both higher and lower risks for inflation. There's also a change there as well. I think overall the door is perhaps a little bit more open for a cut in interest rates in South Africa in May, or of course maybe July, but I wouldn't say that we've reached the end of our interest rate cut cycle in South Africa. But I don't think the statement was really out of line with our expectations. It gives a good summation of where the economy is globally and domestically. And of course, from an investor perspective as well, talking about the uncertainties, we've seen that reflected in financial markets. And of course, there has obviously been a lot of moving parts to this, as you said.
Yeah, as the governor tried to reiterate to the journalist in the room himself. Johann, I want to talk to you. Annabel saying not expected. I do know in previous decisions you were not aligned with what the South African Reserve Bank actually did, having a cut to 75 basis point cumulatively. I do know that you're one of the economists who believe that the SARB could have done more previously. But if we look at the decision just made today, do you think they did the right thing?
I absolutely agree with the 2 members of the committee who voted for a cut, given the circumstances. downward revision in interest rate, in the inflation forecast, inflation that might actually be below 3% during the second quarter of this year, downward revision in growth forecasts, highlighting growth risks. I was perplexed by the view of inflation risks, both to the upside and the downside. I don't understand why they just didn't call it balanced. So, yeah, I'm on the side of the two members of the MPC voted for a rate cut. I thought there was a window of opportunity here. I totally understand the risk that they highlight in terms of the global side, the trade risks from the USA, etc. But I think those risks haven't been reflected in the rand. In other financial markets, yes, but not in the rand. So the rand has been holding up much better than what the Reserve Bank themselves expect. So absolutely, I thought there was a window of opportunity to cut here. But I agree with Annabel in the sense that I think there are possibly more room down the line to cut rates again. And the scenario that the governor sketched in terms of a US economy that might weaken, whereas the European economies might strengthen, and that resulting in a weaker dollar, that will certainly help South Africa in terms of a more stable rand. In line with stable oil prices, we could see more petrol price cuts that will further benefit the inflation outlook. So more rate cuts certainly needed. I think we missed a window of opportunity today.
Okay. Carmen, where or how would you have voted? Because I'm in alignment with Johann, just given the Reserve Bank's comments on the state of the economy right now and acknowledging that economic growth has even come below its own forecasts and further going on to downgrade its growth forecasts for this year, noting that inflation is also low. But nonetheless, taking the stance to rather mind what is happening externally and what could happen and preparing for the worst case scenario, it would seem. But how would you have voted? And what did you make of what the MPC had to say?
Yeah, so I certainly think that not moving on rates because things are uncertain and predictable might seem like a good reason, but it's not clear that this uncertainty is going to go away. The unpredictability will always be there. And I think we have to acknowledge that with increasing global fragmentation, there will be ever more moving parts to take into consideration. So I'm also siding with the doves on this one. I do think that the economy can do with a little bit more help from monetary policy. So I'm not saying slash rates and go all Venezuela. That is not what I'm saying. But we did, as Johann said, miss an opportunity to cut rates today. I think even though we had very strong retail sales data out for January, the consumer can do with a bit of a fillip or support in terms of debt service costs to give them a bit more breathing room. I think the low inflation is testament in part to a still weakish consumer, so lack of sort of buying power. And I think that given that we've all been anticipating this recovery in South Africa for 2025, helping a little bit from the interest rate side would have gone a long way. But I also agree with, if you look at the growth outlook, negative spillovers from offshore, and also, again, a series of months with potentially a 2% handle on CPI, that you could see a resumption of the easing cycle with more, let's call it, backloaded interest rate cuts. And that may then partly be a function of the Fed themselves following through with rate cuts later in the year as the US economy slows a bit more substantially than it has so far.
Okay, but perhaps it's not all lost, as it were. And Annabel, coming back to you and just making reference to what you did say earlier on Power Lunch, you said that you were looking out for what the governor would have to say around the VAT increase that was announced by the finance minister. Obviously, a lot still needs to be done before that is a done deal. But the 0.5 percentage point increase in VAT for this year certainly having an impact on growth. I'd like to understand whether you reckon that perhaps that 0.2% increase on growth can potentially be offset by a little bit of optimism that the governor and the MPC shared regarding what is happening elsewhere in the world, making reference to the latest stimulus package out of China, this time focusing on its consumer, and also making a reference of some increased spend that could come through from Germany and potentially power the European economy. How do you see those squaring out?
Yes, I think it's also important to note as well that the debate we're having about what we would like to see in terms of interest rate movements, and of course, what we have or expected to see from the Reserve Bank is quite key as well. I'm also in the camp we would have preferred a cut, but we expected no change because of the inherent hawkishness of the South African Reserve Bank. And I think to your question, while we obviously have got some bright spots coming out in the global economy, there is, of course, as well, as I said earlier, this remaining uncertainty and unpredictability, which I think is going to run through the Trump administration, as that is the nature of the US president. I think, we obviously have seen the impact in financial markets already. There were some gains in equity markets as we obviously saw the measures come through. We're talking here about China, also, of course, expectations. The governor notes on improvement in Germany, which is absolutely important. If you look at the latest OECD outlook on the economy globally, they worry about Europe in particular, and of course, China as well, two major drivers of the global economy. I think, we would hesitate to make a call yet on whether we're definitely going to get the VAT change or not. But of course, the impact on GDP growth is unwelcome, given that we are at such weak economic growth rates already. I think that the impact on commodity prices as well shouldn't be undercut. We obviously have seen a moderation in global fuel prices, which is very positive for inflation around the world and in South Africa. That comes on the back of weaker demand expectations, but also, of course, as well on the United States pushing for lower prices from OPEC. And that I think is quite key, particularly what happened in the last Trump administration as well. Overall, we're not highly optimistic on South Africa's economic growth rate. For the point of view, we think it's going to be above 2% this year. We remain below the 2% mark in South Africa. We actually remain closer to 1.5%. I think that many of the risks for South Africa have not gone away. And here we're talking about the very slow progress in Transnet. Indeed, if you look at the recent budget presented as well, there's also a very slow progress on the private-public partnerships and other areas of reforms in South Africa. So overall, we think that the VAT increases will have an impact. The risk is that that the GDP growth rate disappoints again this year. However, for inflation, I think, we also feel that the risks are fairly broadly balanced. But that said, one cannot really tell with great certainty where inflation is going to be in 12 to 18 months' time, if not 24 months' time. And of course, given the forward-looking framework of monetary policy, targeting in South Africa, that's the period the Reserve Bank is really looking at. They're not looking at the next 6 months. So I think from that perspective, they're playing it cautious and they're sitting pat and waiting for more developments to come through.
And of course, I mean, in terms of the outlook for inflation, really interesting commentary by the governor this time around, just echoing the sentiments by Jerome Powell yesterday regarding the difficulty of the forecasting environment right now and how it's really difficult for anyone with certainty to say where things are going. But what the Fed did say, Johann, and I want to bring you in here, what the Fed did say is that so far, the rhetoric around tariffs, so far, they do not expect some of the inflationary impacts that could come to be permanent. In fact, using the word transitory that everyone has been banding about, the past 24 hours, just given the fact that it was the word for the pandemic, that wasn't actually realized because, of course, inflation was a lot more sticky than transitory back then. Just your thoughts on what the Fed's thinking regarding, looking through some of the price pressures of potential tariffs, and whether you see any material risk there for South Africa's economy as outlined by the 2 or 3 scenarios sketched by the South African Reserve Bank.
Yes, the way I see it, the Fed's commentary yesterday was in line with what they said in 2017 when the first rate war started in Trump's first presidency. They also then said they will look through the first round impact of tariffs on inflation. And I think this time around, the situation is somewhat different because the policy uncertainty is significantly more. And that policy uncertainty is going to hold back private sector activity, both from business side and from consumer side. If anybody wants to buy a new house or new car or invest more or employ more people, they're going to sit on their hands and wait and see how this unfolds. That creates some downside risk in terms of the inflationary impact. And the Fed has always been more reactionary towards negative impact on the US economy. So if there's any sign that this slowing that was expected even before the Trump presidency started, and this policy uncertainty on top of that, that the US economy might head towards a faster slowdown. And I think probability of a recession has probably lifted a little bit over the recent weeks. The Fed will likely cut rates in the second half of this year. And then the comparison with somewhat better European growth, softer dollar. So that's a more likely scenario, in my view, that will help the rand, that will help our own inflation outlook, and that then might force the Reserve Bank, force is a difficult word, to cut rates again later this year. But in terms of the forward-looking aspect, and that's why I argued September last year that the Reserve Bank should have been more aggressive, because this faster falling inflation was then already in target. We saw that was going to happen. So now we sit with that lower inflation and even lower trajectory going forward. And again, we missed this opportunity.
Carmen, the MPC making reference of what has been happening in the financial markets, the effect that, of course, the US stock market, the rally that we had seen in the recent while has started to fade, and quite a lot of the gains that were posted on US markets in the aftermath, as it were, of Trump resuming his office for the second term have started to peel back, notwithstanding some of the gains that we have seen in the recent while. But we are looking at a JSE in record territory, a little bit soft after yesterday's record close, but still firm nonetheless. And we're also looking at a rand, 1823, okay, still slightly softer than perhaps yesterday's close, but still firm also nonetheless compared to where we have been in recent weeks. I guess my question to you is whether what the MPC presented today strengthens or not the case to buy South Africa, or whether, as Annabel made reference to, in terms of the value-added tax pass-through, whether that still remains a risk, just given the fact that it has not been implemented, it does not really have the support of everyone at hand, and it does present a potential risk of the GNU staying on hold.
So I certainly think that the SA-specific risks have started to tilt away from the upside and potentially towards the downside. So I think historically, where we would tell the Reserve Bank it was doing a good job because it was so hawkish and conservative, I think that is sort of in the base. So you're not going to buy SA because of its sound monetary policy. Yes, it's certainly a factor and a box you need to tick. I think what we really do need to see now is that the reform actually comes through. And there, I think patience may start to wear thin. So what you have seen, you've seen a recovery in consumer as well as business confidence. It's still not above 50, but it has recovered. And now the participants in the economy, particularly business leaders, businesses, need to start seeing the reforms. And that is where, for example, Operation Vulindlela comes in, but we can't just talk about it. So I do think that people have either bought SA listed assets last year. So you saw that massive rally in equities, listed property. The bond market also did well. Whereas equities, you rightly say, now are still doing quite well with various drivers at times. So gold's doing well. At one stage, it was SA Inc. You've started to see bond yields trade sideways to slightly higher. So some question marks coming in there. And then if you actually look at the rand, broadly, it's been stable versus an EM basket. And it's really been a weak dollar story, not a rand strength story. So I think there we also need to be somewhat cautious to say that the rand's pricing in good news in relation to SA, it is actually reflecting largely the weaker dollar. And I think the global markets have already partly priced the shift in terms of the growth delta or impetus away from the US and into Europe. And that's why the dollar is trading where it is. So I would just say it's not as if investors are running towards SA assets now. They probably own it already. and now we actually need to start seeing reform being delivered on, so that the better growth data can actually start coming through quite broadly. So we are treading water, given lots of global but also local risks. So again, the FATF grey listing, the AGOA, where we will be removed. So that is a big question mark.
So let's go down that scenario then, Annabel, and maybe you lead us on this path. Just given the fact that what Carmen is describing, I mean, this weaker dollar environment, this environment where we have seen, and in fact you made reference to the OECD's latest forecast in which they downgraded growth for the US economy, Fitch doing something a little, or the same, a little earlier this week. And gold prices are rallying. We've got gold at yet record highs, and we have seen the benefit for the South African economy. So I feel like we're already in that scenario. But let's go down the scenario of South Africa losing its access to AGOA, which Carmen has just said is going to likely be probable. The Reserve Bank saying that this would result in weakening of our exports and slightly lower growth. Worst case scenario, if we've got tariffs that also follow the removal of AGOA, we could see a weaker rand, higher domestic inflation, and growth being peeled back by some 0.7%. How likely is the scenario in your view?
So I think it's an interesting scenario, Fifi, definitely. And of course, looking at the AGOA legislation, the likelihood of it, South Africa losing the benefits, the free trade benefits, really rests on the fact that it's entirely a US decision. It's not a bilateral treaty. It's not something that South Africa can obviously influence in terms of their decision. The decision's actually made on the back of human rights violations, which the Trump administration feels South Africa has experienced. And of course, as well, there's an alignment among a number of other factors with perceived enemies of the United States here, particularly in the Middle East war. The bottom line essentially is that if South Africa does lose the AGOA benefits, which is our expected case, then we would see up to a 5% reduction in terms of our exports. It may not be that severe. The impact, however, does come through in terms of a loss of confidence. It's yet another drop down for South Africa. We do find ourselves in a situation where the domestic currency has been extremely volatile, and of course that also has a negative impact on investor sentiment. The real bottom line for South Africa, however, is from an economic growth perspective. Investors really want to see a much stronger economy. It benefits both your bond outlook. We don't think we're going to see much benefit to bond yields until we start to hit substantially faster economic growth in South Africa. That's both from the funding perspective for the budget, but also, of course, as well in terms of supply issues. The equity markets obviously have had some benefit from higher copper prices, and that is also an effect of what's happening in the United States in terms of Trump. Not all industries obviously seeing tariffs increases like steel and aluminium or countries. Instead, it's been fairly targeted, but there are these industries that are under investigation, whether it's timber and lumber, whether it's copper as well. And of course, there are concerns starting to build. We already saw a weakness in housing starts in the United States. And obviously, if we have a look at the consumer, some weakness coming there. I would say overall there is concern, Fifi, from a global growth perspective. I think we touched on that earlier with the OECD and South Africa as well. There's also a concern. We started off last year seeing economic growth expectations of closer, well, certainly of above 1%, even closer towards 2%. They were downgraded as we went through the year. Disappointment for the fourth quarter particularly. South Africa also starting the year with economic growth expectations of around 2%, many downgrading these now to around 1.5%. Everything matters in terms of adding to economic growth or subtracting it.
Sure.
So, if we see the VAT increases, if we see the loss of AGOA, a number of other factors, we don't see the reforms pushing the PPPs through faster than currently is expected. There's a bit of a malaise around that. And of course, in terms of Transnet as well, there hasn't been substantial or sufficient recovery. Overall, yes, we do have some concerns about South Africa's economic growth this year, that it may disappoint again, particularly with the Reserve Bank saying their forecasts are closer to 2%. Also, National Treasury as well, basing their budget on stronger growth forecasts. The recent little rise in our borrowings gross loan debt to GDP in the near term, 2 years, this year and next year, was quite largely on the back of the disappointment and the growth outcome, not necessarily on higher borrowings. Of course, the VAT increase is there to raise the extra monies needed. So overall, Fifi, I would say there is a bit of a risk.
Because, I mean, Johann, I think that you and I have had a conversation before regarding AGOA. I mean, some will tell us that, in fact, it's not the end of the world if we do lose our AGOA status, perhaps the end of the world for certain sectors, the likes of agriculture and automotives, but in the main, not anything that should make us lose a hair, except it wouldn't just possibly be AGOA. I mean, we know the fragility of our relationship with the US right now. Our ambassador there got the boot for saying some unsavory things. We do know, as Annabel did make reference to, in terms of how Trump is viewing certain policy regarding land here as well, and concerns that certain people have around what Elon Musk may be whispering in the presidency and how this is influencing how the US is dealing with South Africa right now. So, Johann, again, it goes to you in terms of the probability, I suppose, not only for AGOA, but I mean, what kind of tariffs could or should we potentially be worried about being forthcoming from the US? And ultimately, what does this mean for all these numbers that we're looking at in terms of growth and in terms of inflation and in terms of the possibility of rate cuts?
I think the loss of AGOA status is now almost base case. Everybody expects that. If you don't, then I think you should expect it. So that will have an impact, a downward impact in terms of economic growth. The fact that the euro area and China is probably growing somewhat stronger than what the US outlook is. So there's a change there in terms of expectations. Support for China, support for the euro area, big trading partners of South Africa. So the AGOA impact won't be as severe as one would think that sanctions or specific trade tariffs against us would have. One would think that the prospects or the probability then of significantly higher tariffs or sanctions against South Africa, that's still very low, in my opinion. The AGOA impact, though, is being priced in the markets as we speak. So I think it's more of a sentimental impact. I totally agree with that view, rather than the direct economic impact. So it impacts sentiment, and because it impacts sentiment, then that has an impact in terms of investor confidence in South Africa. To some extent, that's outweighed perhaps by prospects that the fiscal situation, and just okay budget, and the debt ratio peaking far lower than what ratings agencies assumed when they assigned current ratings. For instance, Moody's when they assigned the current rating, they assumed our debt to GDP ratio will peak at 110% of GDP. It's far, far below that. We never got close to that. So some of the ratings agencies, in fact, all of them are behind the curve, really. If we just keep on tracking current projections for the debt to GDP ratio, we should see positive action there. So there's some other factors that we should take into account. It's not all negative but there certainly are risks. But given that the Reserve Bank see downside risks in terms of growth, I also think that should have been a bigger factor. When you adjust growth forecasts down and you say there's downside risks to those forecasts and you cut your inflation forecast significantly, that should have been a situation where you cut interest rates. That would have mitigated some of these coming risks from AGOA and from potential higher tariffs.
So shoulda, woulda, coulda, not happening, unfortunately, for us here, Johann. Nonetheless, thanks so much to all of you for your time. I know there's still so much more that could have been unpacked. Unfortunately, we do have to bring this conversation to an end right now, just to go focus on markets over in East Africa. But Carmen, thanks so much for joining us in New Insights. Carmen, now head of multi-asset strategy over at Terebinth Capital, and Annabel Bishop, chief economist at Investec, as well as Johann, chief economist at Old Mutual.